The squeeze momentum indicator, created by Lazy Bear, is a momentum-based tool often used by traders to identify periods of market consolidation, known as a squeeze, and potential breakout opportunities. Here's a tutorial on how to add it. The squeeze momentum indicator is an indicator that combines two commonly used technical analysis tools. Firstly, Bollinger Bands measure market volatility and track how far prices deviate from a moving average. Secondly, Keltner channels are based on the average true range and help identify trending market conditions. While it may be difficult to distinguish the differences between Bollinger Bands and Keltner channels individually, to make it easier to understand, a chart displaying both indicators together is shown to highlight their differences. So, how does it work? 4 black dots. These appear when the Bollinger Bands are within the Keltner channels, signaling low market volatility. This is referred to as a squeeze, indicating that the market is in a phase of consolidation with limited price movement. 4 gray dots. These indicate that the Bollinger Bands have moved outside the Keltner channels. This suggests that volatility is increasing and the squeeze has been released, often marking the beginning of a potential market breakout. For the histogram bars, the bars represent momentum in the market. Bars above the zero line indicate bullish momentum, while bars below zero represent bearish momentum. The size of the bars reflects the strength of the momentum, with larger bars indicating stronger movement in the corresponding direction. There are 2 key signal types. The first key signal is the entry signal. An entry signal occurs when the dots turns gray, indicating that the squeeze is fired. This should be accompanied by a strong movement in the histogram, either positively or negatively, signaling the start of a new trend. The second key signal is exit signal. An exit signal is identified when the momentum starts to weaken. This is shown by smaller histogram bars, suggesting a loss of strength in the current trend. Now, don't forget to enhance your strategy with additional confirmation. To increase the reliability of your trading strategy, consider incorporating an additional confirmation tool. For example, you can use the Relative Strength Index, RSI, to validate potential entry and exit points, providing a more comprehensive analysis of market conditions. And this is how you add RSI as confirmation. The Relative Strength Index, RSI, is a valuable tool for identifying overbought or oversold conditions, helping to improve the timing of your trades. By combining the Squeeze Momentum Indicator, SMI, with RSI, you can enhance the accuracy of your analysis. 4 bullish momentum. When the SMI squeeze fires and the histogram bars turn green, indicating bullish momentum, confirm with the RSI. Look for RSI values above 50, which signal the bullish zone. However, avoid entering trades if the RSI is above 70, as this indicates overbought conditions and a potential reversal. 4 bearish momentum. When the SMI squeeze fires and the histogram bars turn red, showing bearish momentum, confirm with the RSI. Check for RSI values below 50, indicating the bearish zone. Avoid entering trades if the RSI is below 30, as this suggests oversold conditions and a possible rebound. There's a few sample trading rules for your strategy. The first strategy is called by setup long trade, which means black dots change to gray, indicating that the squeeze is fired. The histogram turns positive, signaling bullish momentum. The RSI crosses above 50 or remains in the bullish range between 50 and 70. The second strategy is called sell setup short trade, which means black dots change to gray, indicating that the squeeze is fired. The histogram turns negative, signaling bearish momentum. The RSI crosses below 50 or stays in the bearish range between 30 and 50. The third strategy is called exit strategy. This means to exit the trade when the histogram bars begin to weaken, showing reduced momentum, or when the RSI moves into overbought above 70 or oversold below 30 territory. These are a few key tips for trading. Number 1, avoid false breakouts. Use higher time frames, for example 4-hour or daily, for confirmation of the breakout direction. Number 2, combine with price action. Look for key support and resistance levels to validate signals. Number 3, risk management wise, always use stop-loss orders and proper position sizing. This combination of SMI and RSI provides a robust trading strategy with a high probability of success when executed correctly.